Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Daryl Thomas, and today you are visiting me from another location. Just got off a flight from Toronto, but I'm happy to be here with my friend, Brien Lundin of the New Orleans Investment Conference in Jefferson Financial. How you doing?
Doing great, Daryl. It was great to see you in Toronto at the big PDAC conference, and I'm glad to be back myself. It was quite an event.
Yeah, I should be getting arrested right now. I feel like I'm breaking that no contact order we talked about because when I saw you
Yeah,
at the restaurant.
yeah, we seem to run into each other all the time up there, despite, I don't know what they had, 20, 30,000 people at the
Yeah, yeah.
conference, and I kept running into you. I thought you were gonna file a restraining order on me or something. You kept running into
Yeah,
me anymore.
yeah, we see each other in Boca, Vancouver, now
Oh yeah,
Toronto. So,
plus all the other conferences. Yeah,
yeah,
man.
for sure. So, PDAC had over, I think it was what, 30, 40,000 people.
hmm
I showed up at the first day, Sunday. It wasn't as much traffic. I missed Monday, then I went Tuesday. And Tuesday it was a drastic difference from Sunday to Tuesday. I guess people may have been flying in, traveling, and such. And so by the time Monday and Sunday picked up, it was packed. It was hard to move around. I mean, it's already a big conference, and they have a lot of different other companies. Like I've never thought to engage with drillers and these other companies that play different roles within our sector. But what was kind of some of the sentiment you were seeing when you were there?
Well, it was sentiment was really good. Everyone was happy and smiling because their portfolios were doing so well. There's some nervousness about the future. You know, people have been conditioned and backward looking, always waiting for a big market sell off over their shoulders. The feeling that it was possibly too good to be true or too good to last. And I understand that. I have the same feelings. After my long experience in these markets, I've seen many pullbacks. But if you look at the fundamentals, and this is one of the things I try to tell people, the fundamentals are still there. The basic drivers behind this market are decades in the making, and they're not going to be diverted easily or anytime soon. But we will have, however, much more volatility going forward with the involvement of the Western investors and traders, and we've seen that kind of volatility. I mean, just the roller coaster ride we've had over the last month or so. We soared to nearly $5,500 in late January, and then gold lost $1,000, silver lost $50 from its peaks around 120. And then we got right back where we were. We got right back up above those levels by the time PDAC came around less than a month later. So I think the underlying trends are there. They are still pointed up. We're going higher over the long term, but there will be these periods where we're going to have extreme volatility. Buy the dips is that's the age-old rule when you have a long-standing bull market. And we're going to have those dips now like we didn't have during the first 18 months or so of this bull market.
Yeah, yeah, for sure. So I'm curious in your perspective, some people were like, okay, are we at a top and such? And so I'm going to share a screen here, but Jeff Clark shared this chart where he shows uh, the duration of the bull markets. And you see like these kind of gaps. So first bull market, 1970 to 74. And then there's a 2-year pause where gold sells off, and then it starts again from 76 to 1980 when Volcker raised rates significantly. Then you get the 2001 to 2008. We have a great financial crisis, sets us back a little bit. Silver, gold sells off, and then you get another run from 2009 to 2011. And then currently we're in the first phase of this bull market. So do you think when people are looking back at the past, are they factoring in kind of these moments where, you have some type of macro headwind that knocks gold off its feet for like a couple of years or a year before then it starts to rebound or whatnot? Just curious in your perspective on it.
Absolutely. I don't think, first off, that anyone knows the future, no matter what the pundits may have you pretend to know. You can't predict the future. You're not going to be able to predict the precise path going forward. That said, we have to recognize the trend here, and we can look to the past for analogs and similarities. The old saying, the history doesn't repeat, but it does rhyme. We may have some rhyming going on. And, I differ from Jeff's definitions a little bit. I look at the 2000s as one coherent bull market. I know some people look at the 1970s as one coherent bull market. I think that we had the great financial crisis was not so much a break, although it was a technical break in the bull market of the 2000s. It was more a culmination of what the metals were fearing all along and kind of predicting all along. The crisis happened, and that kind of accelerated it up to the upside from 2009 to 2011. The 1970s was a little bit different, and I think that I'm kind of attracted to that as a closer analog to what we're going through now, in that Nixon closed the gold window in 1971, severed gold's last remaining link to the dollar, and people thought that everything was just going to go to hell in a handbasket very quickly, and it kind of didn't. Gold shot up from 71 through its its legalization in the U.S. at the end of 1974, but in 1975, it began a bear market that took the price down 50% over 18 months. And then everything did go to hell as we, gold and everyone kind of feared in the early 70s, in the late 70s, and then gold took off again. We may have that right now or a similar situation right now, because gold is taking off in reaction to or predicting as a predictive mechanism what it sees in terms of the debt situation and a lot of other things, de-dollarization, etc. Yet the U.S. is still, zipping along at about 3.5–4% annual GDP growth. Everything's kind of holding together. So we may end up having a year or two of a setback in gold and then a continuation of the bull market afterwards. Who knows? Nobody really knows, but it seems like there's some rhyming with the 1970s going on. But I don't think we could have a 50% pullback when you consider the buying programs that the central banks are undergoing, trying to replace the dollars in their reserves of gold. That price insensitive buying, if the price goes down, the tonnage they're buying is going to go right back up. So I don't think we have perhaps a 50% setback, but, a 25% setback, maybe so, or one that lasts. Right now, we're having breaks like that. We had, at the end of January, we had that big break downward, and it didn't last very long at all. So the uptrend is still higher, and importantly for investors, the mining stocks have not come close to recognizing the metals prices. They still have a lot of catching up to do, and I think that's going to be remarkably profitable, extremely profitable for investors over the months to come.
Yeah, for sure. So just looking at this chart of gold, I'm gonna share. So I just drew out a upward sloping channel on it. And we see that it's in this channel heading upwards. I mean, we've had obviously, October we had, sell off, and then we had one towards the end of January. We went parabolic, another sell off, and it keeps staying within this channel. I mean, it went down a little bit lower than where the channel's support is, but it's staying within this upward channel and it keeps grinding upwards. And so, I'm curious in your perspective on what's happening here. I imagine it's more than one factor. When we get these sell-offs, some people tend to just blame it on the paper markets and paper contracts and the manipulation there. There's also the case for liquidity issues, and so recently, with the spark of the Iran conflict, uh, gold was running up, and then you begin to see, everything correct significantly. Gold, silver went up to above $90 an ounce, and then it corrected to like 70 and some change. Now it's sitting at around 80, close to the mid 80s and such. And so, I'm kind of wondering how much of this is like folks needing liquidity whenever these other assets typically sell off, and then, the metals fall as as a byproduct of that, or is it more of the paper, contract dynamics that's influencing these moves? And so, just curious in your perspective.
Yeah, it's the wiggles in the uptrend that the Western investors bring to the market. For all of those reasons and more, we had a big sell-off in other sectors with the attack on Iran, and so there were margin calls. And when gold is widely owned, and this is what happened in the great financial crisis as well, when gold is widely owned and there's a need for cash right now, then gold serves its role as money in extremis. And it was the piggyback that was broken so that you could get cash. So that's what happens when traders get involved, when the Western investors get involved in gold. It's a store of value. It's something that you rely on in an emergency, and a margin call is an emergency. So it suffers along with anything else. When there's a liquidity crunch, a sharp drawdown across all markets, then gold suffers, mining stocks suffer, everything suffers along with the rest of the babies that are being thrown out the bathwater. So that's part of what happened. Another part of that, what happened, is that traders will buy gold much more quickly than the average investor when there's a geopolitical conflict. And that is really just a game of trying to buy low and sell to a higher bidder. There's no fundamental reason for gold to go up in a geopolitical conflict. And it's the smartest traders are first in and first out, and they end up just handing the bag to the people who come in a little bit later. And that's what happened. They ran the price up and they sold it and ran the price down, and are probably re-entering the trade right now. It's just, generally speaking, it's the wiggles in the line. But importantly, as you noted, with that great channel that you drew, the uptrend is intact. And it gets right back in that uptrend whenever we do have those breakdowns.
George and his team, a 16-year VRIC employee building some of the largest mining operations on the planet. We started a drill campaign, from the drill campaign moving into a full engineering report and study. We came out with our pre-feasibility study in 2021, and it showed a really impressive economic case for advancing the project. We'll have final definitive feasibility out in December of this year. So in the space of 4 years, fully engineered, fully permitted. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
I'm curious if you've dug into there's been some talk about this blue owl and the private credit markets, and like, speaking of liquidity, I'm wondering if this is like systemic risk in the private credit markets. And it's okay if you haven't really dug into that, but just curious if you have any thoughts.
I haven't dug much into it, but I don't really think I need to. There's always these issues come up. It was credit default obligations in pre-2008, and a number of other things, but these bubbles get inflated due to the easy money policies of the Federal Reserve and other central banks, and they burst. There are little bubbles and there are big bubbles along the underlying everything else. So it's not surprising. There will be something. And when gold has moves like this, it's oftentimes, almost always, in fact, predicting something down the road. And whatever comes up is usually out of left field. It's not typically what everyone's predicting, because if it was widely predicted, it would be priced in the markets already. So it's usually a surprise coming up out of left field that people really aren't aware of, and that fits the bill. I mean, the private credit markets got overextended, obviously, over recent years, and some disruption there was not surprising.
Yeah, gotcha. Do you follow much of like the gold to Dow ratio or the gold to S&P ratio? Do you think like the broad equities need to come down more based on that ratio to close?
Yeah, I do follow it. I have some friends in the market, fellow pundits in the market that feel we need a significant correction or bear market in equities to really get the metals going. And I don't subscribe to that. I never have. I think it would be helpful if it can happen without a very significant liquidity crunch. I mean, if we have a liquidity crunch, everything's going down, at least in the short term. Where I differ from some of the other experts and analysts out there is that if there is a significant liquidity crunch or a crash in equities, the Federal Reserve and other central banks are going to immediately respond with floodgates of liquidity. In fact, they're going to have to do what they did after the great financial crisis and what they did after COVID, to the power of 2 or 3. They will have to come in with shock and awe and completely overwhelm the markets to get the same kind of reaction that they got post-COVID or post-GFC. That flood of liquidity will have its own repercussions. It will reduce credibility in currencies. It will have the Fed lose even more credibility in itself. And we might have the bond vigilantes coming in and demanding ever higher interest rates, even as the Fed is determined to drive interest rates and liquidity higher and interest rates lower. So a lot going on, but in this scenario, in that scenario, in just about any scenario, gold benefits. The bottom line is that the markets are addicted to central bank liquidity, and that raises equities, that raises commodities, raises obviously the monetary metals. Everything floats on that sea of liquidity, and that sea of liquidity will be increased in the event of any kind of a bear market correction. So my view basically is gold does not need a correction in stocks. I think that's essentially been proven over the last couple of years. But it may not help, it may not hurt rather, and it could certainly help if it happens pretty much in the manner that I would expect it to.
Yeah, for sure. All right, so curious in your perspective on silver. So silver has these more violent corrections than gold. I mean, we saw at the end of January, I think it fell down 40%. I mean, here recently it was trending towards $94 an ounce, and then fell down to like 79 or something like that. So we're seeing these more violent corrections in the silver market, but obviously we still have the fundamentals of the supply and deficit still kind of out of balance and such. And so, is silver like moving like this because of more of the industrial nature, or is this like paper market involvement? I'm just kind of, trying to make sense of like, why is this metal like so volatile at times?
Yeah, well, silver is doing what silver has done and silver's supposed to do. It leverages gold. It always has in a monetarily based bull market, which is really the only bull markets in gold. So if it's a consistent, coherent, long-standing bull market in gold, silver always leverages gold eventually. This was a unique experience in the history of gold bull markets in that gold rose on its own and by itself for about 18 months of the so far 2-year bull market, because central banks don't buy the traditional levers for gold. They buy gold, they don't buy mining stocks, they don't buy silver. So both of those latter two lagged the market and really created a tremendous opportunity for us, handed to us on a silver platter, if you will, where we could have that risk factor, where we have a gold bull market basically solved for us and still be able to buy the levers at near ground floor levels. So that was a great opportunity. Easy money has been made. And now we have to look forward. Silver, I think, for the first time in my career, is at a stage where I think industrial demand really is a mover for the metal. Most of its value is due to its monetary cachet and heritage. And I really discounted the industrial usages for silver for decades because there's always been a very large above ground supply, no real supply constraints for industry. That's changed after years of supply deficits. That above ground supply is basically been consumed and no longer exists. This, in fact, is the first time in history that industry has to bid against investment for silver supplies. And investment is by choice, it's voluntary. Industry has no choice, it has to get the silver. And so we're seeing industry using the traditionally speculative markets, the paper silver markets of COMEX, and the futures markets in general as delivery mechanisms for silver. We're seeing spikes in silver demand because industry demand is unrelenting, where the investment demand ebbs and flows, and particularly speculative demand ebbs and flows. And we've seen some very desperate rescue operations conducted by the exchanges and the powers that be to rescue the big financial center shorts in silver. It's been pretty obvious that that's been going on. So, yeah, I'm really bullish on silver going forward. These spikes to over $100 to $120 bring their own risk of volatility and sharp pullbacks. But I think over the long term, the price of silver will continue to outperform the price of gold. And again, the price of gold is going higher for all the reasons that we've been talking about.
Mm-hmm. Got it. Yeah, thank you for that perspective. So looking at the equities, you mentioned earlier that the equities still haven't been re-rated as much as they should. I mean, many of them are printing, cash over fish. We had some earnings calls recently and such, and so curious in your perspective on how undervalued are these equities? Are you mostly looking at, okay, their all-in sustaining cost is typically, I mean, I think there's an average of about 1,700 from the World Gold Council, but each company is different depending on when they got the asset and their cost and all of that. And gold's still at 5,000. I mean, they're still, I think the longer that gold stays up this high, the more cash they're going to be printing. And so, just curious in your perspective on equities.
Yeah, there's a lot going on in the for the producers, gold and silver. ASICs, the all-in sustaining cost for gold producers, the last I saw, the average was a bit over $1,800 now and rising. And that's a factor that I don't think people are recognizing enough. The fact that ASICs are rising quickly, operating costs are rising quickly, and they should. A good miner will work to put as much gold, as much ore through the mill as they can. With prices like this, they will be low grading. They will be taking those stockpiles or those areas of the pit that have lower grade and running that through the mill as much as they can. They want to fill the pipeline with as much ore, as much gold as possible at these prices, because even if their operating costs go over $2,000 an ounce, they're still getting a margin of $3,000 an ounce which is the greatest they've ever seen on a percentage basis or a dollar basis in history. So that's the job of these miners, and they know how to do it well. They know, a good operating team knows where to go to maximize their revenues. That's one reason why the supply response for gold will be a bit quicker than in base metals like copper, which might take 15 years to get a significant supply response. It'll take about 5 years or 6 years or so in gold to get new mines produced, but in the meantime and immediately, and as we're seeing right now, the mines can come up with somewhat of a supply response as long as their mills are filled or running at nameplate or slightly above. So we're getting a bit of a supply response from the producers. For developers and exploration companies that have resources, they're starting to recalculate those resources at lower cutoff grades if they have the drill density to be able to do that. And that's increasing their resources and the value of their projects as we speak. It's a lot going on right now. We're starting to get some responses by the miners and developers, et cetera, to these gold and silver prices, but it's going to be slow. And I think prices are still going to be rising in the meantime. I don't think it's going to dent or deter the uptrend anytime soon.
Okay, got it. So when investors are doing their due diligence, I'm kind of curious in your perspective on, you have these exploration companies that are, they're in the process of permitting, getting their feasibility studies and things of that nature, and they're not expecting to start producing until around 2029, 2030, and that's assuming that everything goes according to plan, right? And then you also have those that are in the development stage that do have their pre-feasibility studies, and they have to raise, multi-millions of dollars. I was actually looking at a company recently that has all their PFS and everything, ready to go, the permits, but they have to raise $400 million or so. And so I'm curious, and they didn't have a lot of cash on hand either. So, I'm kind of wondering, okay, are they going to dilute? Or is someone going to come in and acquire? Just kind of thinking through that. So so for me as an investor and investors in general, when they're looking at these early stage exploration versus and those that are going into development, what are some things they should be considering with, factors like permitting, timelines, and then having to raise capital to go into production?
Yeah, investors need to consider it all. You need to get an estimate from the company when they think they're going to go into production, and then you need to temper that estimate and cut it back a bit because something always happens. The good thing, and really the different thing in this market is that companies can find the money to develop their projects. It used to be a truism, and especially in the exploration game, that the explorer should explore and the miners should mine, and you shouldn't try to bring your project to production. Eventually, you would have to sell the project to a major or a mid-tier, someone else who had experience in production. But right now, and juniors would bluff their way saying, trying to say that that's an option for us. We can bring the project into production as a way to get the highest price. Now they don't have to bluff. The money is there. A $400 million capex is not something that's out of the reach of a developer right now. The money is in the market, whether that's through debt, equity, forward sales, hedging, or whatever, royalties. The money is there in some form or fashion. And it's not just there, but investment banks and other sources of capital are bidding to finance projects. So, it's a competitive marketplace, and you can get fairly cheap financing, or cheaper than you could a year or two ago. So it's interesting. A developer that never wanted to get into mining can actually do it, and as such, they are the natural other bidder against any big producer. They can just choose to go it alone and build the mine. It's a completely different world. There's a lot of money available from investors, and it's not just investors within the market. It's investors without the market too, outside the market. The generalist investor, generalist money is there. It really is, the majors have yet to go on a buying spree. I think it's only a matter of time. But they're going to find that the market's not that easy. It's a seller's market and not the buyer's market that they've had over the last decade or so.
Yeah, yeah, for sure. I was just thinking about specifically that was what I was researching on Vista Gold and just looking at their project and such, and and just reading through their
You can
presentation.
find the money to produce that themselves, and they have what has traditionally been viewed a fairly high cost, low margin project. That kind of a project in a market of rising gold prices actually offers more leverage than other kinds of projects, and for a number of reasons is much more appealing.
Yeah, for sure. So obviously, like as we go further down the chain, I imagine the deals aren't as sweet as they normally would in a bear market. And so Wheaton just did a deal with the silver stream. They bought the stream from BHP, and it was a multi-billion-dollar deal. I think it was $4 billion and some change or something of that nature. And I was kind of just trying to work out the math, which I'm a shareholder of Wheaton. This is not financial advice. And I was kind of wondering, like, okay, 20% of spotted silver, a certain amount of ounces and such. I mean, it's gonna produce cash, but I was thinking, like, okay, to pay that acquisition off is going to it could take a long time, but it also depends on how high silver prices go. And so I'm just kind of wondering, like, do the deals aren't as sweet? I mean, because most of their deals that they got, like, during the bear market were, significantly better. I mean, they've had an average cost of $4 to $5 per ounce of silver, $4.50 for an ounces of gold on their streams and such. And then this one seems like not as good as the other ones.
Yeah, they're getting more competitive. Those kinds of deals, there's not many companies out there that could do it. And it's very likely, I have no knowledge of the background or the inside workings of how that deal came about, but it's very likely that Franco was in there too with its price or its offer, and Wheaton paid a bit more. So that's the effect of competition, as it is in any market. It's the same on royalties. The margins get skinnier, but the guys at Wheaton aren't stupid, and they're not dumb, and obviously they have a bullish outlook on silver. But that was an accretive deal. You can rest your worries on that. It would have to be accretive for them to do it. They are really smart. But royalties, the market is highly competitive, and unless a company has some kind of a demonstrable advantage of either finding royalties that everyone else somehow are overlooking, or building their own royalties as some other companies do, it's getting to be a tougher and tougher business. But it's a great business if you have a good royalty. From an investor standpoint, if you work your way down the food chain with companies that have royalties that are not yet producing, that's a lower quality. Time is money. And if you're looking at a smaller royalty company, you want one that has some differentiating factor, some type of an advantage. And you definitely want that is very close, if not already in, revenue producing royalties.
Yeah. Yeah, for sure. I mean, because Wheaton's already, printing cash, and I mean, they've yet to come out with their fourth quarter earnings from last year. I think they come out with those this month, and I'm imagining it's going to be amazing. And then, so there's no doubt that they're going to be able to recoup and pay the debt off, and all of that from this acquisition. And, I'm kind of thinking like, well, the bigger royalty companies, they still have to invest in growth. And this is a jurisdiction that they're already involved in. They already have a stream on this same mine and such. And so they're not having to take on the risk of going into another jurisdiction or whatnot that may not be as, investing that type of capital into another jurisdiction that, that could be, more riskier or whatnot. And so, it makes sense,
Yeah, and royalties are one of the other ways to finance a project. There will be a lot of projects being developed, and I think what you're going to find is as that game gets more competitive, as existing projects already sell off royalties, if they're going to sell off royalties, there's less product out there. But the one place where there is a lot of product is mines that will be developed at these prices. We're going to see more and more of that. And that's a financing option for a lot of developers going forward. You lose some of your leverage and exposure to metals, but if it's not your primary metal, if it's a gold project and you want to do a silver royalty, or even vice versa, or a copper project that does a silver royalty or gold royalty, you can remain more pure to your business model, but still find fairly cheap financing.
Mm-hmm. Yeah, for sure. What do you think about the balance of silver streams versus gold streams? I mean, obviously silver's a lot more volatile than gold and such. And so which one would you prefer? Like if you were, running a royalty company, would you be looking at more of the gold streams or the silver streams?
I think if you're I have a preference for companies that are in gold and silver. And there are companies that focus only on that, which means you have to either get your gold or silver out of, say, a copper mine, which is doable, or you have to accept some copper in your royalty stream. But I would, silver, the pricing depends on where the silver price is. And obviously that fluctuates a lot from day to day. But with the trend that we recently saw, I would think that a lot of silver royalties have gone up in price. It's a good thing to have a silver royalty. I don't know that right now I'd want to be in the market where I have to rely on finding and buying silver royalties, because the price has undoubtedly gone up if you can find them in this market. As an investor, I think a silver royalty gives you tremendous leverage, but it just depends on whether it's accretive to the company that you're buying and what their cost basis was. If it's a silver royalty that they bought last year, they're probably sitting pretty well right now, and that would be a fairly attractive investment.
Mm-hmm. Yeah, for sure. Curious in your perspective on the smaller royalty names. You have companies that are coming up, and they're probably, I would say, tier 3. I would say that tier 2 would be like the Ors, the Triple Flags, formerly Sandstorm, which was acquired by Royal Gold. But then you have like the gold royalties, the Empress royalties, the Elementals and such. And so, and I know that some of them, to find some of these deals in these markets, I mean, they're having to look at other places where some of the bigger companies are not looking or not interested in and such. And so just curious in your perspective on either the risk, with having to get streams or royalties and mines in certain parts of Africa versus, I imagine they're going to have to go out to some of the other untapped areas or mines or whatnot and provide those financings to continue to grow. Obviously, Elemental has, in gold royalty, I mean, they have Tether as a shareholder and such, so they have some major backing. I mean, Empress has Endeavor Financial, and such. And so just curious in your perspective on where do the opportunities lie for, those smaller companies.
Yeah, it's a recipe, and recipes vary rather, and some of them are more appealing to the taste than others. Empress has great backing. Their model is to build the royalties as part of the financing package for companies. So that's their differentiating factor. Other companies say we're going to go for a particular niche in the market that the big guys don't do and the little guys can't do. So that you have to look at what those differentiating factors are. You have to also look at what the royalty stream is, the revenue stream looks like. Are they making money now? And how long will they be making money? Some of these royalties don't run for, they have specific terms. They might be 4 or 5 years. They might be as long as the project's around, but there is a time limit to all of them. So you want to look at that. Is the revenue going to fall off if they don't do any new deals? They don't talk about deals until they're done, so it's kind of difficult to get a handle on how many new deals are coming up. You really can't get a good idea of it. So you have to have some confidence in management's ability and the like. Generally speaking, royalties carry a much higher premium in the market because they're usually diversified and they usually don't have the management issues. They just need they don't have the management hassles, and all they really need is the product. So yeah, it is a mixed bag. There aren't that many new ones coming out that are really attractive. There's actually one that I'm looking at in Gold Newsletter that I was really impressed with their package of royalties. In some cases they've got royalties on companies that we are recommending in Gold Newsletter. So it's kind of a way to leverage our portfolio as it currently stands. And so I haven't recommended that company yet, but I am looking at it closely. Yeah, it's a great sector, but there's so much to look at. You have to really see how close they are to revenue and when that's going to come in. The further they are from revenue, the more discounted they are from that revenue, from both the time and risk factor. Really, time is risk. So that might be a way if you have a longer time frame, investment horizon, then you can get better deals with the companies that don't have royalties yet, but they're riskier and you have to wait around for a while.
Yeah, for sure. Yeah, appreciate that. So last question, just curious in your perspective on the tokenized gold products that have been, I've been running across a few companies that have been doing tokenized gold. I know Tether has, and that's kind of been, I guess, resolves an issue of the portability of gold. I mean, many of the Bitcoiners would argue against gold, would say, well, you can't take a bunch of gold bars across the international lines, and now you have tokenized gold. However, it does add a layer of counterparty risk and such. And so, curious in your perspective on the development of that technology and part of the market.
Yeah, I think it's good for the market. You do accept more risk, and there's no such thing as a free lunch. To get something, you have to give up something. And for gold, if you want that liquidity, then you have to give up you have to accept more risk. You have to accept more counterparty risk. It will fundamentally be the same as a gold ETF. What's your confidence that the gold is really there? But the added benefit of that is that when an ETF, you're putting your money up to own the gold, and you're accepting that risk of whether the gold is really there. For some of the tokenized gold options out there, you're going to gain something even more. You're going to gain liquidity, ease of use, etc., with essentially the same risk as a gold ETF. So I think it's going to work. Frankly, I think it really solves and bridges that gap between a digital asset in gold itself. The ability to actually transact in gold is and will be great, but I think the big advantage is the ability to save in gold, because people will still use, I mean, Gresham's law tells us if you have gold and you have, you will hoard the better money. So you won't necessarily want to reduce your gold holdings to spend them, but at least you can save them and easily convert them into the cheaper money, being, in our cases, the dollar, and spend that. So the cost in transferring from one to the other is an issue in itself.
Yeah.
And
yeah, for sure. Yeah.
There should really be very little of that, if any.
Yeah. It does seem to add another layer of liquidity. I mean, obviously counterparty risk, but the tether, you can buy the tether gold token at any time of the day, 24 hours a day,
Yeah.
7 days a week. You're not in some back alley trying to sell your gold. You can sell it right there on the exchange, when you need
and
liquidity.
you can hold gold. And, that's the important thing. I think it solves some very real problems of gold.
Mm-hmm. Yeah, it was actually pretty good to see, because some people were using that as a metric to see what gold was doing when the attack on Iran happened.
The PAX gold and the like, you could actually get a price and see how it spiked over the weekend when the gold markets were technically closed, or at least the trading markets were. There's always a gold market open somewhere, back alleys or otherwise.
Yeah, for sure. So last, I mentioned that was the last question. I forgot to bring this up.
Second to last question.
Fabi Costa brought this chart up about new gold discoveries worldwide. In the last 2 years, there have been 0 major discoveries. And he mentioned that this has never happened before. Curious if this is a nothing burger, or is this a major issue?
Yeah, it's a something burger, but it's more of a slider than a big old, double stacker, as it were. It's not a whopper, as it were. What really drives gold is demand at the margins, monetary demand, and that tends to obscure any of the supply issues at any time, because every ounce of gold that was ever mined or virtually every ounce, is still out there in some form. So it's got not much flow to stock, as it were. But it is illustrative of the issue that it's going to be difficult for there to be a supply response to these high prices. And I think it's even more important for other metals. You could draw the same chart for copper or silver or any of the base or energy metals. Discovery is getting harder and harder. It's something that'll be solved to some extent by price. But when you have these supply constraints, especially for metals that are strategically important and critical, then you get things like the government stepping in, not for gold, but silver is a critical metal, and a number of other critical metals and rare earths. You see the government stepping in, and that kind of funding, that kind of strategic investment will overwhelm any economic considerations or any high capex project for rare earths or uranium or gallium or any other critical metal. If the government wants to secure supply, it's done. It doesn't really matter what the economics may be. And there's a lot of money out there. What we think are huge amounts of money for capex of major mining projects is not even a rounding error for the federal government budget. As we saw with Doge, they were trying to cut back spending and didn't even make a dent in the spending trajectory in the U.S., despite all the waste and fraud that they were able to uncover. So, there's a lot of money out there from the government, from the markets, and it's flowing into these very small markets. So, Tabby does great charts. He does, I think, the best charts out there. And that factor, the fact the fact that it's hard to find mines, that there has not been that much money spent for gold and other mines, and developing those projects and finding those projects, that adds to the story. I don't think the story needs it, but it's a good sweetener on top.
Yeah, I noticed that the Doge savings disappeared off the national debt clock site. I was trying to find it the other day.
Oh,
And I was like,
they took that off? I was
I
kind
think
of dubious about that. They were really very optimistic about Doge for some reason. In the site that's built on pessimism, they were optimistic about what Doge could.
Yes, for sure, for sure. So where can people connect with you? I imagine you're planning for the New Orleans Investment Conference at some point in this year.
Yeah, we're
Whatnot.
going to make some announcements in that regard. We're getting some really exciting speakers confirming this year. So I want to lock those in before I make all of the announcements, but very excited about this year. It's October 28th to 31st. So it will end on Halloween. So if you've never been to New Orleans for Halloween, and you don't have to be elsewhere for Halloween, we're adjusting the schedule too and the agenda, so you can come and still get home, come to New Orleans and still get home in time for Halloween, wherever you may be. So it is the best investment event out there by most people's estimation. Really virtually everyone's estimation, except one person we both know very well by the name of Rick Rule. But it is a unique event, very valuable. So go to neworleansconference.com to get all the details on that. And you can go to goldnewsletter.com to learn all about my publication and the stocks we're recommending in this junior mining stock market. We have an extraordinary track record, just added yet another 10-bagger to our portfolio as far as results from our entry points in the stocks. And it's going great guns. And so you can go to goldnewsletter.com to learn all about that.
Yeah, that sounds good. Well, you all have the information. Thank you, Brien, for coming back on the show. Look forward to chatting again. And I'm sure I'll find you somewhere in the world sometime this year.
We will unavoidably run into each other, Daryl, down the trail. So looking forward to that as always.
Yes, indeed. All right. Take care.
Take care. Thank you so much.